Welcome back to the vlog. Today we are going to jump into chapter 4. All right, so chapter 4, understanding what indicators identify. All right, in chapters 1 and 2, I point out that securities prices are sometimes trending. They have a strong directional bias, and that trends are punctuated by retracements or small moves in the opposite direction before the trend resumes. At other times, prices go sideways, called range trading. Finally, trends end, and after they end, they may reverse to the opposite direction. So indicators identify 5 conditions. Note that in this list, I put some suggestions next to each condition, but someone else could name other equally valid indicators. A trend beginning, moving average crossover or pattern breakout. A trend is strong or weak, momentum, slope of linear regression. A trend is reaching or retracing but will likely resume, relative strength index. A trend is ending and may reverse, momentum, moving average crossover or pattern breakout. A price is range trading, slope of linear regression, or moving average. Each indicator works best in one situation and less well in others. Technical traders argue that the merits and drawbacks of indicators in each situation. And if you ask 10 technical traders to list their top indicator for each task, you'll get 10 entirely different lists. Most traders use a fixed set of indicators and try to remember that indicator 1 is pretty good at validating rising prices like the moving average, while not so hot at identifying an impending reversal. For that, they may prefer indicator 2, the MACD. Traders don't identify conditions and then apply indicators. They leave the indicators on every chart and expect to remember how to rank reliability under changing conditions. Choosing your trading style. Identifying trendedness is always your first task, but which trend over what time period? Take a good hard look at figure 4-1. All right, which depicts a downtrend that consists of 4 legs down punctuated by 4 legs up. If you knew at the beginning of this chart how it was going to look 3 months later, how many trades would you take? There's no single right answer. If you sold at the first high and bought back on the last bar, you'd have one outcome. Instead, if you sold at every peak and bought at every bottom for a total of 8 trades, you'd have a different outcome. In fact, your total gain would be higher than the one trade version, assuming you could buy at the lowest low, and sell at each tippy top, something you should never assume in technical analysis because it's unrealistic. Calling the one trade person a trend follower and the 8 trade person a swing trader has gone out of fashion. In practice, both are trading trends. They just have different durations. Both trading styles may or may not entail going short. To go short is to sell a security you don't actually own. You borrow it from someone else through your broker with the intent to buy it back more cheaply. If the security is priced at $10 and your indicator tells you it's likely to fall to $5, that $5 gain from the short trade is just as green as the gain you get from the long trade. That is, buying at $5 and selling at $10. In commodities and foreign exchange, shorter term swing trading is the norm. In equities, getting broker permission to go short can be hard and expensive for most traders. Most retail equity traders can go in only one direction, long. They can buy, but they can't go short. This removes half of the trading opportunities your indicators will deliver. And when you get to the point of back testing your indicators, you need to specify whether you can trade in both directions. If figure 4-1 represents your security and you can only buy, you have 4 trades. Which type of trader are you, the longer term or the shorter term? If you're a beginner, don't decide just yet. Let your indicators choose for you. As you begin to apply indicators to the chart of the securities that you like, some will appeal more than others. They will make sense to you and you'll be comfortable using them, and your chosen indicator will work better in some time frames than in others. And after you have a small set of preferred indicators, you can employ a scan available in many software programs to find other securities on which your indicators work well, expanding your universe of securities. How about being a trend follower in some securities and a swing trader in some other securities in your portfolio? Chances are good doing so could end up becoming confusing, but there's nothing wrong with it in theory. Fading the trend. Prices often move 2 steps forward and 1 step back. Sometimes you see a pause in an uptrend arriving, and you know that early buyers are about to take profit, setting off a domino effect of falling prices. You know the uptrend is well established, but instead of waiting for the trend to end, you sell your position and also go short today with the intention of exploiting just this one small down move retracement. Selling into an uptrend sounds counterintuitive, but in practice, retracements are fairly reliable. Trading the retracement is called fading the trend, and it is a standard operating procedure, especially in futures. Fading the trend works best if the counter trend trade is a very short-term trade, such as hours or days long. When you fade the trend, you break a cardinal rule of technical trading. To trade with the trend, which is based on the Dow principle that once a trend is established, the probability is high that it will continue. Therefore, to fade the trend is a purely opportunistic action based on an understanding of crowd psychology. Fading the trend also illustrates the frame of reference of technical trading that isn't the security and isn't fundamentals, but crowd behavior. Just remember, swing trading against the trend requires lightning speed, total concentration, and nerves of steel. If you choose longer term trend following, you choose to suffer through the downward bounce and the uptrend. Figure 4-1 shows 4 downward moves. Whether you can sit them out is a function of personal patience combined with confidence in your indicators. And that is it for today. I will see you next time for examining how indicators work, finding relevant time frames, and establishing some benchmark levels. Until next time, peace.